Good morning. This is Stacy Carter, and thank you guys for joining us again. This is our sixth coffee and conversation in a series that we are doing for everyone because we've, as a owner of Pathways Senior Care Advisors, I have found that so many people just don't know what to do to prepare for the later years in life, and people are actually living longer and still don't have a plan, and then something like a pandemic hits and sometimes those plans even change. So what we've done is put together a series of topics that can help you with that, whether you're just in planning mode or whether you do get in that crisis mode. So what I want to do is turn it over to Mary Coron to talk a little bit about pathways and introduce our guest speaker for today. Mary?
Thank you, Stacy. Good morning, everybody. We're really privileged to have a great speaker with us this morning on a topic that's very important, because there are lots of facets to making the correct decisions about Social Security. Wish that it would be so simple that you just signed up and that was it, but that's not the case. So this morning we have with us Kara Endres. She is a vice president of financial and estate planning with Baird Financial Planning. Is that we, up until recently, very lovingly called Hilliard Lyons here in Bowling Green. But Baird is a wonderful company, and I think has added a new dimension, don't you, Kara?
Yeah, absolutely. Absolutely. It's a great company to work for. I think we all miss the Hilliard Lyons name, but Baird has been a great transition.
Absolutely. Well, let's start talking about Social Security a little bit, and I guess maybe begin with, what are the eligibility requirements for Social Security?
Yeah, so as soon as someone starts working and paying taxes towards their Social Security, they start earning what's called credits. And you have to have 40 credits to be eligible or fully insured under Social Security. You can only earn 4 credits every year. So in 2020, if you make $1,410, you're going to earn 1 credit. If you earn $5,640, you're going to get those 4 full credits for the year of 2020. So as soon as you accumulate those 40 credits, you are considered fully insured under Social Security.
Okay, well then, how is the benefit determined?
So the benefit is determined on your lifetime earnings history. The 35 highest paid years on your record are used in your calculation. So from a planning perspective, if I can put my financial planner hat on for a minute, one of the recommendations that I make to the clients that I work with is making sure that you take a look at your Social Security statement every year and make sure that your earnings are being reported correctly, because that is what is going to calculate your Social Security benefit. If you're age 60 or younger, you actually won't receive that paper statement in the mail anymore. So you will have to create an account with the Social Security Administration by going to www.ssa.gov, and you'll create an account and you'll be able to pull your Social Security statement right there. If you're age 60 and older and you have not created an online account, you will receive a paper statement, and you'll receive that statement about 3 months before your birthday every year. I do recommend creating that online account if you can, because one of the nice features is that every year you'll receive a reminder that says, hey, your Social Security statement has been updated. Take a look, make sure your earnings have been reported correctly. So again, make sure you look at that statement and look at those earnings and make sure that those are accurate.
Yeah, I'll put an exclamation point on that. I went from one job to another, and the second job was higher paying than the first one, and they just kept reporting the same pay level. So I had to talk to them and get it changed. So that's a really, really important recommendation. When can a worker start receiving Social Security benefits?
So you receive your full benefit, 100% of that full benefit, once you hit what's called your full retirement age. Your full retirement age is determined on your year of birth. So if you were born between 1943 in 1954, your full retirement age is 66. If you were born in the years between 1955 and 1959, it's going to be somewhere between 66 and 2 months and 66 and 10 months. With ultimately anyone born after 1960, your full retirement age currently is 67. Now you can claim benefits as early as age 62. However, if you claim benefits early, you are choosing to receive a reduced amount. So if your full retirement age is 66 and you decide to claim that benefit early, then your benefit is going to be reduced by 25%. If your full retirement age is 67 and you claim at age 62, then your benefit is going to be a 30% reduction. On the flip side, you can wait as late as age 70 to claim your Social Security benefit. And there's actually a pretty nice incentive to delay your Social Security benefit to age 70 past that full retirement age amount. So if you wait past that age 66 or age 67 age, then you actually receive an 8% increase in your benefit every year. So again, if you wait until you're age 70, that could mean increased income of anywhere between 24% and 32% for the rest of your life. So if you expect a long life expectancy, that can be a pretty significant difference in the income that you receive from Social Security. So anywhere between 62 and 70 is the window for claiming Social Security.
Okay, then who will benefit from a retiree's work history?
Yeah, so not only, it's not just yourself that could potentially benefit from your work history or your earnings history. So your spouse could receive what's called a spousal benefit. A divorced spouse could receive benefits on your record. A survivor, so if you pass away and you have a surviving spouse, or if you have a surviving ex-spouse, they could also claim on your record. And then if you happen to retire and you have children at home, children can also benefit from your work record as well. Yeah, so there's lots of different claiming strategies and different types of applications that can be made.
Well, tell us more about the strategies for those different situations.
Okay, so we'll start with spousal benefits because that's honestly, from a planning perspective, I spend a lot of time talking to married couples about different claiming strategies. Because for a married couple, it's really important that you look at both work histories, both statements. So a spousal benefit is the equivalent of 50% of your spouse's full retirement age amount. So you could receive up to 50% of your spouse's full retirement age amount. Now you can't receive both. You're going to receive the higher of the two. So you're either going to receive your own benefit if it's higher, or when you go to make that claim, if 50% of your spouse's benefit is higher, you're going to receive that spousal benefit. So it really depends on which one is higher, whether your benefit or 50% of your spouse's. A couple of things there. So one is your spouse has to have claimed and started receiving their benefit for you to be able to claim a spousal benefit. So if they haven't turned their Social Security on yet, you can't file a spousal benefit. And then the other requirement is that you have to have been married for at least a year to be able to be eligible for a spousal benefit. And you can, just like your own record, you can choose to claim spousal benefits as early as age 62. But again, if you choose to claim that spousal benefit at age 62, then you're not going to receive 50%. You're going to receive a reduced amount due to claiming early.
Okay, thank you. That's great information. So what is the impact if you keep working while receiving benefits?
Yeah, so that is definitely something to consider. So if you decide to turn on your Social Security at age 62 and you're still working, the benefit that you receive could be impacted. And something called an earnings limit is put into place. So if you claim at age 62 and you make more than the earnings limit, so in 2020, that earnings limit is $18,240. So if you make above that amount, $1 for every $2 above that amount is going to be withheld. So for example, let's say that you make $5,000 above that $18,000 limit and you claimed at age 62. Social Security is going to withhold $2,500 worth of your benefit before they turn on your claim for that year.
Oh, wow. And then, will my Social Security benefits be taxed?
So yes, Social Security benefits can be considered taxable. And that's all based on what your modified adjusted gross income is. So if you take a look at your tax return and look at the line item that says adjusted gross income, and then if you have any tax-free income on that tax return, you'll want to add that back in. And so if that number for a married couple is above 44,000, then 85% of your Social Security will be part of your taxable income. If it's between 34,000 and 44,000, up to 50% of your Social Security could be taxable. No more than 85% is going to be taxable. So that's the absolute most of your Social Security that will be part of your taxable income. But it's all based on what your modified adjusted gross income is. And that modified, excuse me, that modified adjusted gross income includes pensions, investment income, capital gains, IRA distributions. So basically thinking about all your income sources. For a lot of married couples, you get to that $44,000 target pretty quickly. So for most of the clients that I work with, somewhere between 50% and 85% of their Social Security is part of their taxable income.
Wow. So you mentioned pension. How does that impact my Social Security benefit?
Yeah, so your pension income, the type of pension it is really depends on whether it's going to impact your Social Security or not. So if you're receiving a pension from a corporation or a public company, then it's security taxes on. So your benefit will not be impacted by that pension. Now, if you had pension income for wages that you did not pay Social Security taxes on, so typically that's going to be government agencies, teachers, those are the most common ones that I see. Your pension could impact what your Social Security benefit is. The most it could impact it is the equivalent of 50% of your pension. So it's not going to fully impact your benefit. But again, if you had employment from somewhere where you did not pay Social Security taxes, then it could impact what the benefit is that you receive. If by chance you had both a work history where you paid Social Security taxes as well as a work history in which you didn't, if you had 30 years of history of paying Social Security taxes, then your pension may not affect your Social Security at all. So it just really depends on how much pension income you have and how much work history you have on where you paid Social Security taxes. And that's called the windfall elimination provision. So really it keeps you from double dipping, for lack of better description.
Okay, well, gosh, this is complicated, and I guess we need to talk about what should a retiree consider when they're trying to make a decision about when to file for Social Security.
Yeah, so there's four main things that I really take a look at when I'm helping clients kind of guide that decision on when to claim Social Security. One of those is, are you going to continue working? Especially if you're before that full retirement age amount. So if you're claiming early between that 62 and potentially age 67, are your earnings going to be above that earnings limit? Because it really doesn't make a whole lot of sense to turn on Social Security if ultimately they're just going to hold all of your checks. So at that point, you've turned on an income stream that you're not even going to receive. So if you're going to continue working and you're retiring early, or you're trying to claim that Social Security early, think about that earnings limit. The other thing to really think about is your health and family history, kind of an idea on longevity, right? So the longer that you anticipate living, the better off you're going to be the longer you wait to turn on that income stream. You know, if you are in relatively poor health, or you look at, you know, longevity on your side of the family, you may want to kick on that income early, potentially. So you may have heard people talk about break-even points, you know, between claiming early versus full retirement age, or full retirement age versus age 70. The break-even age for most of the calculations that I've done for claiming early versus full retirement age is in your late 70s. The break-even point for claiming at full retirement age versus age 70 is somewhere in your early 80s, usually around 80, 81, 82, maybe at the latest. So if you look at your health and you look at your family history and you really feel like there's a high probability that you're going to live past that late 70s to early 80s mark, then it could make sense to delay your Social Security as long as possible. The other thing I think to go ahead. The third thing I think to really consider is, are other people eligible to claim on your record? And this becomes especially true for a married couple, because your decision on when you file for benefits could impact your spouse, right? So if I chose to claim my Social Security early at age 62, and my spouse didn't really have much of a work record, you know, let's say my husband stayed home with the kids and didn't pay into Social Security the way that I had, the fact that I claimed early, if something happened to me, he's going to receive a permanently reduced benefit for the rest of his life as well. But if I had chosen to wait to turn on my Social Security till that later date and something happened to me, he's going to bump up to that higher amount, and he's going to receive that higher amount for the rest of his life. So, you know, the decision that you make on Social Security could very well impact the benefit that your family members ultimately receive. So kind of looking at, for a married couple, is very important.
Yeah, so you make that decision based on all the things you just talked about, and something changes. Can you alter your decision about filing for Social Security benefits?
Yeah, so there's a couple of ways to alter your decision. So one way is to withdraw your claim, but there's some rules around this. So you have to make that withdrawal within a year of your first check. So if it's past a year, if you've been receiving Social Security for longer than a year, you can't withdraw your application. The other caveat there is you have to pay back all of the benefits that you had received up until that point. The other option is you can actually suspend your application once you reach full retirement age. So let's say at age 62, you decided to turn on your Social Security income stream, your Social Security benefit. You hit full retirement age, you're somewhere between age 66 and 67. For whatever reason, you don't really need the income anymore, or, you know, maybe claiming early you decided wasn't the best decision. You can actually file an application to suspend your benefit at that full retirement age. And at that point, you would start receiving those delayed retirement credits. So you'd start receiving that 8% increase in your benefit every year. Now, if you turn off your Social Security, if you suspend your Social Security at full retirement age, and let's say your spouse was drawing a spousal benefit, if you suspend your benefit, that spousal benefit is also going to be turned off. So if anyone is claiming on your record and you suspend that benefit, their benefit is also going to go away as well. So there are a couple of options. It's a little bit more difficult to turn off Social Security than it is to turn it on.
This has been great information, Carol. We really appreciate it. Are there any questions?
I have a question.
Yeah.
You talked about ex-spouses being able to draw on their record. Is there a requirement on length of the marriage or time since they divorced on that?
Yeah, so you have to have been married for at least 10 years to your ex-spouse to be able to claim a divorced spousal benefit. And it would be the same as the spousal benefit. So the most that you would receive is 50% of your ex-spouse's benefit. And again, they're going to look at both records. They're going to look at both your record as well as the ex-spouse's record and you're going to get the higher of the two. The other difference that I think is worth mentioning is, for spousal benefits, your spouse has to be claiming and receiving a benefit for you to get a spousal benefit. If you're divorced, your ex-spouse actually does not have to have claimed and started receiving his or her benefit. They just have to be eligible for Social Security. So meaning that they have to have those 40 credits and they would have to be at least age 62. So they don't have to be receiving a benefit for you to be able to receive divorce spousal benefit. So that's a little bit unique difference between the spousal benefit and a divorce spousal benefit.
One other thing I just thought of, is there something still about a widow and a blackout period I'm trying to think of, that something about age 60, is that still in force?
Yeah, so from a survivor benefit standpoint, unlike your own benefit where you have to wait till age 62, a survivor benefit could be turned on as early as age 60. And another unique planning feature with a survivor benefit is you can actually choose between the two records, okay? So let's say your spouse passes away and you're age 60. You could actually turn on your survivor benefit at age 60 and let your own benefit continue to grow. And then you could switch to your own record once it, reached that higher amount, either that full retirement age or age 70. So there are some claiming strategies there for a surviving spouse that are unique, that are kind of a unique situation.
Thank you very much.
You're welcome.
Thank you, Kara. Obviously, Social Security is something that is a very important piece of people being able to get the care that they want later on in life. Certainly, it's a piece. There are many others. Social Security rarely pays for all of the care a person needs. But if you've made the right decisions and used the right strategies, it certainly can be very helpful. So we really appreciate you being with us this morning, Kara Endres with Baird Financial Planning. Thank you very much.
Thank you.
Thank you for having me.
You're welcome. Bye-bye.
Bye.